And good afternoon. Welcome into Market Talk on this Tuesday, February 8th. Thank you so much for joining us and making us part of your day once again. I'm your host, Jesse Allen. Find us online. MarketTalkAg.com is our home on the web. You could find all of our streaming sources there, all of our social media links, the latest news of agriculture, and much more. It is all online at MarketTalkAg.com. Well, we saw an interesting day throughout the trade here, one day ahead of the USDA WASDE report on Wednesday. We saw a little profit taking in quarter beans. We saw wheat with some strength, and we saw the protein sector, a little bit of strength there as well. Let's talk about all of it. Let's bring in our good friend Jim McCormick with agmarket.net joining us here this afternoon. Jim, great to have you, sir. How are you?
I'm doing very well. Thanks for having me on, Jesse. Appreciate it.
Appreciate it, Jim. We got a barking dog in the background of the show today. We'll try to get her to calm down a little bit here. But as we jump into things, Jim, I want to talk just to start. We're a day ahead of this WASDE report. Some interesting dynamics in the market trade. What did you make of the profit taking in quarter beans here today?
Well, I think profit taking is definitely the best way to describe what we saw in the grain complex, Jesse. I mean, the fact is we've had a hell of a run up in the beans and the corn here the last couple of weeks since the January WASDE number. The trade is really looking for a pretty drastic cut potentially in the South American crop. But the reality is the government's probably not going to cut it as much as what some of the private estimates are thinking. So I think that was enough for people to say, you know what, I'm going to step aside, see what the number is, and then see what happens. Because right now, with the way the computers trade, you got to guess the report, but then you got to almost guess how the computer programs are going to trade that number. So a lot of people just chose to step to the sidelines. We'll get the number, and then they'll reposition.
Well, I think about this as well. We get that report in tomorrow, and I'm curious what USDA is really going to say numbers wise. I know the pre-report estimates, the private analyst estimates, everything is all over the board as to what things will look like in South America. And I think that's been our biggest focus is this weather situation and the dryness concerns down in parts of Brazil, Argentina, Paraguay, and Uruguay, Jim.
Well, exactly. And if my guess, Jesse, is they're going to take it very cautiously. I think, they'll put it somewhere between 8 and 10 million metric tons when it's all said and done. I know some of the rhetoric is as much as 20, 25. But if you look what happened last year as kind of history, last year the crop in Brazil went down to 129 was the rhetoric. And when it was all said and done, it ended up closer to 138. So the trade kind of overshot it to the downside, and then they came back up. I think the government's very leery to do the same thing. They don't want to cut that crop in February just to raise it back up in March. So they tend to walk it down. Like I said, that's where the question is going to be is how does the trade look at it? Is it, if they only cut it 7, 8, is the trade going to view that as bearish and they're going to sell it? Or is the trade going to say, hey, that's the first of multiple cuts. Let's buy that break. And, that's what's going to put a lot of volatility in tomorrow's action more than likely.
And we'll look at quartered soybeans, kind of together here a little bit. I mean, if I'm a producer, these are some pretty awesome levels we haven't seen, in months, and for that matter, in quite a long time, if you throw out 2021. But I mean, looking at some of these levels and ahead of this report, what am I doing here? Am I doing anything different with my marketing? Am I looking at things right now and saying, hey, I should probably build in some sort of risk control here, or am I taking some profit here? What are you thinking as we head into tomorrow's report, Jim?
I think with the run-up we've had, the uncertainty on this number, the uncertainty of what's going on in the Ukraine, you look at the profit margins you have right now, I think you want to protect it. And it's not going to be super cheap, but something you might look at. And I did this for several producers today. We looked at the week 2 options that expire on Friday. They're relatively, you can pretty much buy an out of the money call, roughly 1 to 2 strikes out of the money for less than a nickel. On the beans, 20 cents, 25 cents out of the money for less than 15 cents. So for a nickel, 15 cents, you can buy a put if you have a lot of unpriced grain to protect yourself in case we get a bearish reaction to the report. On the other hand, if you want to take a little bit more limited risk, maybe you'll sell the cash market and then come in there and you can buy a slightly out of the money call. So if the government gives us a bullish reaction to the report and it explodes higher, you step right back into a futures position, or if you exercise a call on Friday. So a relatively inexpensive way to protect yourself, because the dollars, when you start doing the dollar calculation, the kind of revenue you're locking in, we're encouraging guys to make sure you protect that, because everyone knows you just don't know how, A, what the government's going to say, and B, how the market's going to react to what they say.
Jim, I want to talk about the wheat market a little bit here today. We did see some buying strength there, especially on spring wheat. We got that Stats Canada report out here earlier today, and it was lower than expected, 15.56 million metric tons for Canadian wheat inventories, down 38% compared to 17.88 was the trade expectation. And that really seemed to give us fuel in spring wheat that spilled over into the winter wheats. Was there something else there? Or do you think it was mainly that Stats Canada, that bullish report here today that helped us out?
And it was the Stats Canada number, no doubt about it. I mean, the reality is that crop is a lot smaller. The world supply of wheat is tighter than the trade was thinking. We'll see if that gets reflected in tomorrow's world number from the USDA. But when the wheat rally, essentially what it looked like to me is the spring, we said, hey, we've got to buy wheat acres, or we've got to defend the acres that guys are thinking about planting. But you look at the price of corn, you look at the price of wheat, look at the price of cotton, look at the price of rice. Everything is profitable. Barley up in the northern part of the country. So when the world, very tight situation of food in the world right now, with China hoarding most of the world's reserves, we can't afford to stumble. And you're starting to see end users, I think, panic a little bit when they saw that wheat number in Canada be tight as what it was. I think you saw guys come in and say, I've got to kind of get some of that inventory controlled, because, like I said, if you get the bean rally up here, maybe you're attracting bean acres that we don't need, corn acres, and with being on top of it, Jesse, you got the inflation going on, the inflation talk around the world. So you got spec money coming in at record amounts, wanting to own commodities as they try to hedge off inflation. We got an inflation number here at the end of the week. It's probably going to be red hot, which is probably just going to increase more money into the commodities.
Well, and you mentioned inflation as well, and I know we saw the stocks rebound a little bit today. Crude oil, though, has been on a tear, although it is lower today, and that also seemed to be a little bit of our downside pressure as well today, with crude oil and some of our, palm oil, bean oil lower. But we look at some of those outside market factors as we head into the report. I mean, what are some things you're watching outside market wise that's weighing or helping the grain markets for that matter?
Well, I think the two things you need to watch is the crude oil. Like you said, it was down a little bit today after getting over $90. There was maybe some people are spending some positive discussions between the French and the Russians due on this Ukraine crisis, and maybe that took a little bit of pressure out. There's also some talk that maybe we're making a little bit more progress on this Iranian nuclear deal, which potentially could bring more oil onto the world markets, and that caused the market to pull back. But the crude oil market, or crude energy, is pretty much in everything when you think about it. How we produce the food, how we transport the food, the clothes you wear. So the crude really is a great indicator of inflation. So whenever you see that crude oil start working higher, it's kind of the canary in coal mine that would suggest you're going to get more money coming in to all commodities. If crude goes up, maybe you're going to see it in the livestock, in the grains, in the softs. So that's one thing. The other thing we're just kind of keeping an eye on is the US dollar. If the dollar goes up, it makes our products a little bit more expensive. If the dollar goes a little bit weaker, it just makes us that much more competitive on the world number, or the world market, excuse me, and that drives demand. We are seeing right now, which is kind of unprecedented in a way, Chinese are buying beans for spring, summer delivery from us right now. Normally, this window for us to export is shut tight. But as the Brazilian crop stumbles, the Brazilian guys are holding on to their beans. That demand is coming to us. If that dollar would weaken, it just makes it that much more reasonable for the Chinese to come in and buy U.S. grain.
That's a great point you make as well. Just the amount of Chinese purchases here we've seen, or unknown destinations, we presume it to be China in recent days, really has been impressive for this time of year. And I think that's something we're going to watch very closely moving forward to see how much more of that we end up with. Jim, I know as well you guys wrapped up your winter meetings. You guys were in Kansas City yesterday, and I know weather's a big topic. And I know you guys had weather part of that meeting. Where we're looking at the dryness in South America. We're starting to get some rumblings in the trade about some spring weather models in the U.S. and whatnot, maybe a little bit drier here and there. Did you guys gather anything from your winter meeting yesterday in Kansas City on the weather front that we need to maybe keep an eye on?
Well, Drew Lerner, excuse me, of World Weather Inc. was our special presenter of the weather. And in general, kind of to summarize it for Drew, I hope I can do this right. But in general, the bias it got is it looks like it's going to be, his modeling is projecting a little bit warmer, drier bias, especially in the Western Corn Belt. And that is a real concern when you talk to producers out there. They said, look, we ended up a pretty good crop last year when it was all said and done, but they drained the reserves. And we just haven't had a lot of snow and winter rains or late fall rains to replenish that ground moisture. So if these models are correct and some of these cycles are arguing that we could have a warm, dry summer. Now, Drew was very cautious, say he's not calling for that. He didn't go out that far on the limb, but he's saying, look, if you look at some of these maps, some of the breadcrumbs, this could be a legit problem. So if you're a producer out there, I mean, it's going to be very volatile, but it's just some great opportunities. I've been telling my producers, the reality is right now, if you can buy options, you can buy short dated puts that'll put a floor, May short dated puts, Jesse, that'll put a floor under your new crop until you get a better handle what these acreage numbers are going to be in a correlated grain stock. They're not going to be dirt cheap. It's going to cost you 20, 25 cents to protect the corn, but you're not protecting, Jesse, a 2000, a 20, 25, 30-year-old truck. You are protecting a brand spanking new red Ferrari. The money that's out there in that field, you've got a lot of expenses. It's going to cost a lot of money to produce this crop. You got opportunity to protect it. Protect it. Your opinion means nothing if the market breaks. Your banker's not going to say, well, I'll take your opinion was the market was going to go higher and you didn't sell it. You still got to pay off that note. So when you look at these high input costs, our argument at our conference was take advantage of what's out there, market the grain, take opinions out of it, look at it as a business approach and take advantage of the tools that are out there, puts and calls to manage that risk.
It's great advice because I think where I was going to end with that point as well is that it just feels like the computers and the algorithms nowadays, they take every little nugget of information they find out there, Twitter, news headlines, whatnot. And so, you start whispering of drier forecast possibly. And I wonder how much the trade really takes that into account just with the way we trade nowadays, Jim.
Well, they take it I think they take it a lot. And, because they're all looking for that little bit of an edge. The computer is looking for the edge. And that's also what makes it much more challenging now than compared to what it was 10, 15, 20 years ago. 20 years ago, you're worried about what the U.S. weather market was, a little bit of export demand. The ethanol wasn't there. Now you're looking at crude oil. Crude oil affects ethanol. Crude oil is going to affect beans more and more as we get more and more renewable fuels. That's what we're looking at. We look at Brazil. The winter market used to be a dead time of year, but with Brazil exporting so many beans in the world, you can't rest in this time of year. It's a very crucial, it is the heat of the summer for Brazil. And that's why we're getting this volatility because the world is counting on the Brazilian beans to supply. And something to kind of consider, Jesse, if Brazil can't produce a bushel of beans, that demand's not going away. It's just got to find a different supplier. And that's what people are so bulled up or potentially bulled up about what's going on in South America. If you would lose 20, 25 million metric tons of beans out of South America and you push that demand back to the United States, that carryout's not over 300. You got people talking 200, 150 million carryout. If you get that carryout down to 100, 120 million, the argument is how high do you got to go to ration demand? That's what we're trying to find out. And we won't, how high we go depends on what South America does. So it's going to be a very volatile season, not just the next February, March, but all the way through our production cycle.
Jim, I want to give us time for livestock today. Hogs had another impressive move higher. A lot of these summer months, well over $100 here. What is your take in this hog market here, just with all the momentum we've been seeing lately?
Well, I think you got to be a little bit cautious, Jesse. It is technically overbought after the run-up we've seen, but on the fundamental side, I mean, everything I'm hearing is the hog supply is going to continue to tighten into the summertime. You can't find the baby pigs, you can't find the isolines. They're not there. It's very tough. It's going to be hard to expand the industry, in my opinion. Labor shortages are a huge problem. So even if you got to these huge profitable levels, historically, when you get these profitable levels, you start hearing people talk about expansion. You're not hearing that right now. The cost to expand is, a barn is very, very expensive because of the inflationary cost of construction. But even if you did build that building, can you find somebody in rural America to help run it? You can't. So I think you're seeing that. And then on top of it, you've got the cattle market kind of, they're worried about what could happen there. If we have a dry spring, what's going to happen is you might see some herd reduction, because who wants to feed $6+7 corn if we have a hot, dry summer? So essentially, you got the traders looking at the long-term effect of the protein market, saying maybe we'll get a glut of supply if we do see some liquidation of herd size. But then it's, all of a sudden your supply down the line tightens, and that could really be compounded by demand. We're coming out of this Omicron crisis, it looks like. A lot of people are going out, and I think it's a good sign. Just a note, a couple of weeks ago, I was at a farm show in northern Michigan. They had 1,100 people respond. They went to that farm show. It was probably the biggest group of people I've spoken to in years. It kind of felt like the good old days, if I could say that. But I think that's a sign. It shows people want to go out. They want to go on vacation. And that demand is going to be there. And like I said, we've got a constricting supply on top of demand that wants to go out. It sets us up for a very interesting situation later on later on into 2022, into 2023.
And piggybacking off that, on cattle, one other point there, we had a couple weeks there where we had some forward contracted cattle. Looked like maybe we were pulling back a little bit, but now it seems cattle finding some footing here. We're still looking, 160, 170 feeder cattle, and fats are still holding this 140 range. And, to your point as well, as we work out of the COVID pandemic and look at more demand, it looks like this cattle market still has some room for maybe some upside potential, although we are at some pretty impressive levels.
There's no doubt about it. We're going to struggle. I mean, we're hearing like some of the higher cuts are definitely going to struggle a little bit right now. And that in a way is kind of to be expected. I mean, February is not a big grilling, it's not a big going out to eat month. We do have Valentine's Day, which will get a little bit of a bump there, but really I see that demand really come into the springtime. But I'm very bullish demand in the springtime. Like I said, I think there's a lot of pent up demand of people wanting to go places and do things. And I think that hopefully will be a good sign for the beef market.
Jim, any other final thoughts you have for us here on this Tuesday before we run out of time?
Well, what I just encourage producers really to, like I said, look at your balance sheets, look at your break evens, market what's profitable. Don't market what your opinion is, because the market doesn't care what your opinion is. The market's going to do what it's going to do. You just need to be able to try to protect that revenue. There's some phenomenal ways to do it with a board of trade with options, redoing risk. But we're looking at price levels that we haven't seen in a long time. You don't want to let these, profitability levels slip away from you.
Well, Jim, if producers need some advice, I know they can reach out to you and the team there at agmarket.net very easily. What's going to be the best way to reach out to you guys?
I think the best way, honestly, is go to our website, agmarket.net, subscribe to our research right there, and get a look at us and see what we're saying. And, get a question, give us a call.
With that, Jim McCormick with agmarket.net. We appreciate time on this Tuesday, sir. Have a great one. We'll talk to you again soon.
Thank you. Have a good week.
Jim McCormick with agmarket.net joining us today here on Market Talk. That's going to do it for the show on this Tuesday. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.